Hey, I'm Bob, the Mortgage Coach Mitchell, and we are talking about glossary terms today. The next one up, we're in EMs, and the next one up is margin. The margin is part of the components, one of the two components that go into figuring out what your interest rate on an adjustable rate mortgage would be, particularly at the first adjustment. So on the index, that might be like something like the 52-week average yield of the 1-year Treasury note. That's a number that they publish in like the Wall Street Journal and that sort of thing. That's called an index. That's what your interest rate's going to be based upon. Now, to that index, the lender is going to add the margin, which is what we're talking about today. That's the profit to the lender. So if you take, let's say that the 52-week average yield of the 1-year Treasury note is 4%, and you have a 2.5% margin, you're going to take the 4% plus the 2.5% and add those together. That's going to be the fully indexed rate and subject to caps, which is what we talked about before. That's going to be your fully indexed rate. So right now, for the purposes of this glossary entry, the margin is the profit to the lender. That's the amount that the lender adds onto the index to figure your fully indexed rate. So if you have any questions about that gobbledygook or why you don't even want to mess with an adjustable rate mortgage, give me a holler. I'm Bob, the Mortgage Coach Mitchell. Now, let's put you into a house. Bye-bye.